This week on the Retirement Quick Tips podcast, I'm recapping the stock market, the bond market, and the economic climate of 2024 and looking ahead to 2025. Today, I want to do a deeper dive on the bond market, fixed income. This includes CDs, corporate bonds, municipal bonds, the entire fixed income market. It would also include money markets and, as an outlier, cash, which I think is an important component of and certainly qualifies in that sort of fixed income, although it doesn't provide much fixed income, but it fits into that category. So one of the key themes for fixed income or bonds in 2025, I think, in my opinion, is going to be a slower pace of interest rate cuts by the Fed. The Fed cut rates 3 times in 2024, if my memory serves me correctly, but we still have stubborn inflation. Now, it's certainly not anywhere near what it was back in 2021 when it was like 9%. I think it peaked at like 9 or 10%, just absolutely insane. Anyways, but it's not back to its target. And so the Fed is trying to, in their movement of raising or lowering interest rates, they're trying to achieve a reasonable amount of low inflation. Their target is 2%. Now, I believe that I'll have to look into this more because I remember reading that 2% is going to be pretty hard. We're good with 2.5%. So they're like moving the target now, which is problematic. Regardless, inflation remains above target. And we also have a healthy labor market. So it's likely that they're just going to be way more cautious about lowering rates any further, because if they lower rates too far, if they make missteps, then that's going to contribute to reigniting inflation. And we do not want that. That would be very bad. So they need to be careful here. And so I think that their approach, I'm often critical of the Fed, and I don't like how they waited so long to start raising interest rates. Oh, it's transitory. Inflation's transitory. That's what they kept saying. It's like, no, it's not. If you have eyes, if you have ears, if you go to the grocery store, no, not transitory. Anybody with half a brain, I think. Anyways, I digress. But I think they are doing the right thing now, which is being very cautious and slowing the pace of interest rate cuts. And that's going to be key for 2025. So the projection currently, and this is always a moving target, but right now the projection is that there's going to be 2 smaller rate cuts of only 0.25% each in 2025. So rates aren't going to move that much. If that happens, we'll see rates, at least on the short end, decline by 0.5%. Now, this is pretty good for fixed income investors because right now you can still get decent rates on CDs, corporate bonds, municipal bonds, even money markets are still paying above 4%. Regardless of whether you're in shorter term or intermediate or longer term bonds, or you have a lot in the money market, this more stable and relatively unchanged, or at least expectedly unchanged interest rate environment in 2025 should help to kind of maintain the status quo. So we're not likely to see rates on your money market drop from 4.25%, where a lot of them are right now, to like 1% or 2%. You can buy CDs and corporate bonds and put together a bond ladder. It's a really attractive time to do that because we want to lock in rates while they're still relatively high. So rates are in a period of going down. And so if you kind of keep everything in the money market, keep it parked in your savings account and cash, that is a big risk because you could miss the boat and the opportunity to buy fixed income and buy bonds right now and lock in 4 or 4.5% for the next 3, 4, 5, 6 years. And that's an area where I think investors, if you're being proactive, you want to take the opportunity in this still relatively high interest rate environment to lock in rates and not just sit parked in a money market. Now, there is the individual aspect of it where, yes, it makes sense in many cases to maintain a lot of cash or a lot of money in the money market, especially if you are retired. You want to have enough cash available, liquid, accessible if you have a planned purchase coming up. So this isn't a blanket recommendation to like sell all of your cash, drain your savings, and invest it all in bonds. No. But if you are holding excessive amounts in cash or in money market, then there is an opportunity right now that may not remain later in the year and into next year to lock in rates at pretty high levels where they still are currently. Now, on the flip side of this, the interest rate environment, what this also means is that if you're looking to buy a house, if you're looking to take on new debt, you're likely not going to see much relief this year in mortgage rates, car loans, credit cards, like all those rates. If you have debt or you're looking to take on new debt and you don't like mortgage rates at 6-7%, I'm sorry to say it doesn't look very likely that mortgage rates and car loans and all those are going to drop significantly either. Okay, so I mentioned moving out of money markets and short-term bonds. I would preferentially lock in rates a little bit further out. I wouldn't maintain everything in the short end because as rates continue to decline, you're going to see those rates reset. Whereas if you lock in by buying bonds a little bit further out, again, 3, 4, 5 years, you're able to maintain a stable income at a pretty decent level. You can get 4.5, sometimes even 5%, although I don't see that as much anymore in bonds that go out a few years, and then you get to collect that stable income. Whereas if you just keep it in a money market or a very short-term bond fund, that's going to reset and continue to do that as rates continue to go down, albeit at a much slower rate. So again, stable interest rate environment, I think, is good across the board for bonds, for stocks. The only thing it's not great for is if you have debt that you're servicing right now at higher rates, or if you're looking to move and you're waiting for mortgage rates to go down. I just don't see that happening in 2025. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.